A landlord in Ohio bought a $200,000 rental property in 2022. He did everything right. Good neighborhood, solid tenant, professional property manager. After the mortgage, taxes, insurance, and repairs, he was keeping about $300 a month. Meanwhile, a land investor in the same state was selling a $10,000 parcel on owner financing terms, collecting $250 a month, 0 tenants, 0 repairs, 0 mortgage, same income, 1% of the capital. That comparison is what we're breaking down today. 5 rounds, real numbers. And I'm going to be honest. Rental property wins some of these. This isn't a sales pitch for raw land. It's a real comparison with real numbers. Let's go. New here? Subscribe. We break down raw land investing every week. It's free. Round 1, entry cost. Winner, raw land. The national median home price in America is currently around $240,000. A conventional loan requires 20% down. That is $48,000 before you have paid for anything else. Add closing costs, inspection fees, early repairs before you can rent it. Add the cash reserves any smart landlord keeps for emergencies. Realistic entry to a rental property, $60,000 or more. Raw land. County tax auctions, where we find the deals covered on this channel, can start at the back taxes owed. Sometimes $300, sometimes $800, sometimes $2,000. Even buying off-market from a motivated seller, rural parcels in the states we have covered regularly sell between $2,000 and $5,000. Round 1 goes to raw land. It is not close. Round 2, cash flow. Winner, rental property. Let's be honest here. A properly purchased rental property, in the right market, generates real monthly income in a way that vacant land typically does not. If you buy a duplex at a good price in a growing city, and both units are occupied, you can clear $800 to $1,200 a month after expenses. That's real cash flow. Consistent, predictable, monthly. Raw land on owner financing terms generates income too, but it is typically smaller. $200 to $300 a month on a $10,000 parcel is realistic. For immediate monthly income, rental property wins this round. Round 3, maintenance. Winner, raw land, and it's not even a competition. This is where rental property investors rarely do honest math. Year 1, the furnace goes out, $4,000. Year 2, a tenant leaves without notice, 2 months vacant, $3,000 in lost rent. Year 3, a roof inspection reveals it needs replacement, $12,000. That is not worst case. That is normal. Every structure ages, and every appliance eventually fails. Every tenant is a variable you cannot fully control. Even with a property manager handling the daily calls, you are still responsible for every major decision on a building that gets older every year. Raw land. Dirt does not call you at 2 a.m. Dirt does not stop paying rent. Dirt does not need a new water heater. Dirt does not require an eviction filing. The annual cost of owning a rural parcel of land is often $20 to $100 in property taxes. That is it. Round 3 goes to raw land decisively. Round 4, appreciation. It's a tie, but with an important nuance. Residential real estate has appreciated significantly over the past 2 decades. The average American home has roughly doubled in value since 2005. But here's what most investors miss. When a house appreciates, you get 2 things working in opposite directions at the same time. The land underneath appreciates. The structure on top depreciates. Buildings age, they wear out. They require investment just to hold their value. The appreciation you see in home prices is largely driven by the land beneath, not the building sitting on it. Raw land captures that appreciation cleanly. No depreciation drag, and no aging structure eating into your returns. Both asset classes appreciate over time, but land does it without the hidden cost. This round is a tie, but land's appreciation is cleaner. Round 5. Risk. Winner, raw land. Rental property carries risks that raw land simply does not have. Tenant. Risk. A single non-paying tenant can cost you 3 to 6 months of income, plus legal fees during eviction. One bad tenant experience can erase an entire year of cash flow. Structural risk. Buildings can burn down, flood, or develop foundation problems. Every structure carries liability that vacant land does not. Market risk. Residential values are tied to interest rates, local employment, and school districts. When those factors shift, values can fall sharply and stay down for years. Raw land risk is primarily one question: can you sell it? If you bought land with road access, clean title, and reasonable zoning, there is always a buyer somewhere. The market for affordable rural land has grown consistently. It does not disappear the way housing markets can. Round 5 goes to raw land. The final score. Raw land, 3 rounds. Rental property, 1 round. 1 tie. But here's the honest conclusion. Rental property can be an excellent investment. A well-bought rental in the right market, held long enough, with good tenants, builds real wealth over decades. The investors who do best with rentals are usually experienced, well-capitalized, and prepared for the management burden. Raw land is a different game. Lower entry, lower maintenance, lower stress, comparable appreciation, strong cash flow when sold on terms. The strategy nobody talks about. Here's what the smartest investors actually do. They do not choose between raw land and rental property. They use raw land to fund rental property. Here's how it works. You find a tax-delinquent parcel for $900. You sell it on owner financing for $6,500. You collect payments for 3 years and net $4,500 in profit. You take that $4,500, you flip another parcel, and net another $4,000. After 12 to 18 months of land deals, you have accumulated a $20,000 to $30,000 down payment, enough to buy your first rental property with cash you did not have before, that you built from parcels most people walk past. That is the progression many serious land investors follow. Raw land. First, because the entry is low, the margin is high, and the experience teaches you to evaluate property. Then, rental property, funded by land profits, acquired with real knowledge of what real estate actually costs. The Ohio landlord we mentioned at the start, he is not doing anything wrong. He just started at the wrong end of the sequence. If this is the kind of content you want more of, the subscribe button is right there. It actually helps the algorithm decide whether to show this to more people who need to hear it. Next video, 5 raw land deals that went wrong and exactly what I learned from each one. You do not want to miss that one.